This is Tonight. I'm Bruce Whitfield, and about 350 million rand has been wiped off the value of some 15 money market funds. It's extraordinary, and it has caused some panic amongst investors. Andrew Canter is with Futuregrowth, and Leon Campher is the chief executive of ASISA, the Association of Savings and Investments South Africa. Has this happened before, Leon, where the Reserve Bank has unilaterally written down the value of money market funds?
Not that I'm aware of, and maybe Andrew can comment, but I mean, there's been issues before, but this has been the biggest issue. And the 350 million write-off, I mean, I can understand why investors are angry, but the fundamental bottom line is if you go into a money market fund, firstly, the constant NAV has never been guaranteed. The second thing is you're doing it because you want to increase your yield. So to look in isolation at the 350 write-off is probably human, yes, but it's not right.
It may not be right, but the thing that has shocked a lot of people, and people who have been communicating directly with me, is ABSA has taken X amount out of my account. Stanlib has taken X out of my account. The issue has not been communicated at all by any one of the asset managers. They seem to think that us kippies who live in the real world understand what Jill Marcus was talking about when she said we write down the value of the debt from 100 to 90%. And that seems to be, that is enough of a message being sent out. And ordinary people haven't picked up on that message.
I think I can't really comment, on communication by ASISA members. If it has been poor, they must deal with it. The fundamental point is what people tend to forget. There's a law which says if you take a haircut in a money market fund, you write it off against income first. And then secondly, if there's not enough income, you cancel units so that the 100-cent constant NAV remains intact. And I believe if they haven't communicated that to their unit holders, that's a poor show. And it also goes to the way in which these things are sold and the way in which we perceive, and I say we, people outside the investment industry, perceive money market funds. It's a money market fund. It's money market. You want high interest rate, you go to a money market. There is no perception of risk. And in that lies the issue, doesn't it, Andrew? Because most of us don't. If I've got a money market fund, I don't know what the underlying assets are. And even if I looked at a list of the underlying assets, I wouldn't have the foggiest clue what they represent.
So that's really the point, isn't it? But let's go back to first principles. I think investors need to understand that the losses that have been taken on African Bank are in the unit prices now. Anybody that's panicking out now, it's kind of pointless. Yeah. The horse is bolted. Your units are down by 0.5% or 1%, or in some of the equity funds more. So that's done. But your point is right. But so money market funds invest in a diverse range of banking and commercial paper from various issuers, any one of which can go bankrupt, which means any given day you can lose a little bit of your money. It's a loan. It's a loan to various parties. In this case, African Bank went bust, and we lost some of the money that was invested with African Bank in the senior debt. But on the other hand, if you've been a depositor in African Bank, if you've been holding a 1-year NCD to African Bank, you could have lost that full 10%. You understand? Instead of losing one fraction of the 10%, you could have lost the full 10%. Now, in fact, depositors have been protected by the Reserve Bank, but there was no guarantee of that either. In a really bad case, that may not have been the situation. So I still think there's a strong argument for investing in diverse funds with active management, notwithstanding that many managers missed the fact that African Bank was in trouble, was still holding the paper, including us, in small percentages. So the diversity argument does prevail. It's a low fee, and you get a higher yield in the end. Net.
But that's the point, isn't it? If there was zero risk, well, then you would get 3%.
Yes.
Exactly. There is risk built in, absolutely, so you get between 5.5% and maybe 6% and a bit percent.
Exactly.
The higher that yield, the more risk the money manager is taking, the more ropey potentially the paper could be. Now, what are the rules and regulations? What protection do I have from having a money market manager going completely mad? There was an incident 4 or 5 years ago, perhaps a little bit longer, with the ABSA money market fund, where they were holding crazy instruments.
Yeah. So the crazy instruments now can't happen.
Who defines crazy?
Reset instruments, structures that are opaque to the investor are not allowed.
Instruments with embedded derivatives in them.
Yeah, absolutely. So in the context of a money market fund, the rules are very simply, your weighted average duration can't be more than 90 days.
Why does that matter?
Because it's a money market fund, so it has to be fairly short in duration.
That means it has to be very liquid. It must always be able to meet client flows. And also, if interest rates were to move sharply one way or another, it won't cause a capital price effect.
Okay.
So very capital stable funds, intended to be competing with bank accounts, basically. Okay. Sorry, Leon.
Yeah. So legal maturity of the paper you hold, not more than 13 months. That avoids the, as Andrew referred to, the kind of reset instruments where you have floating interest rates and you can kind of reset.
It avoids on a regular basis the sort of mess we're seeing with African Bank.
Sort of, except that if you invest in a 91-day African Bank NCD and then reinvest and keep reinvesting, when African Bank hits the wall, you're still holding a 91 NCD. Yeah. So that's the reality of kind of.
So that's in terms of duration structure, but also within that, it limits you to what exposure you can have. So of that portfolio, for banks with a market cap over 20 billion, you allow total exposure of 30%. But in aggregate, not more than 10%. Banks smaller market cap, you can hold 20%, but in aggregate, not more than 5%.
But the point being, I mean, this is quite technical stuff. The point is, it's a bit like a pressure cooker. There's a safety valve. The pot is designed to not explode and spray shrapnel across the kitchen. Andrew, I mean,
that's right. I mean, any fund manager worth his salt has exposures much less than what the regulations require.
Yeah.
You know, it's like the 10 Commandments. Most of us don't really need the 10 Commandments to live, but they're there as a backstop. So that's just good fund management. And so some of the losses, the bigger losses taken in the unit trust industry, were taken in funds that were not money market funds. They were income funds or aggressive or yield enhanced income funds with much more aggressive mandates, seeing much higher returns. Risk goes with returns. So bigger exposure limits, even subordinated instruments.
Has the African Bank blowout proven that money market funds work? That the regulations are right? That the environment is adequate to protect the interests of savers?
I think it has. I think there are certain instances in the regulation that we might have to work on to receive greater clarity and have a process in place where things happen quicker.
Yeah.
And I must commend the regulator. They've been very good in this instance in working with industry discussing matters. Having said that, Andrew makes a good point in the others. I mean, that's where you are shopping for yield and high.
But that's more specialized, and you kind of go in with your eyes open. What's scary about the money market accounts is these are retail products. You go into the bank, the person behind the counter goes, yeah, I'll give you a money market. And you go, yeah, excellent, thank you very much, I'll have the money market, sign here, and off you go. And 9,099 days out of 10,000, there isn't a single issue with it.
No, in fact, the last time I can remember this kind of event was in the U.S. in 2008 during the financial crisis when Lehman's went bust. And eventually the U.S. government had to step in and almost guarantee the money market funds to prevent a run.
Yeah.
So the mechanism does work.
Absolutely a very good point there, because internationally at the crisis, what was happening in the money market funds, they were incorporating in the portfolio some of the instruments we have now said are not appropriate for money market funds. And when the trouble happened, the government had to step in. Hence, now there's a debate internationally, both in Europe and the US, whether the constant asset value money market funds should continue to exist. And by that we mean a unit price of 100 cents or $1, unit price of $1. In the US, what they've now done is they've said for institutional money market funds, which pension funds, everybody invests in, or the very wealthy investor, they cannot now have constant NAV.
Now, I noticed you smile when I asked Leon whether or not the regulatory regime was adequate. Leon suggests that it is, and it needs a bit of tweaking. Your smile suggested to me that you have a different view.
The regulatory regime actually is pretty good and adequate. I agree with Leon. From the rules that are followed, from the policing that goes on, it's very good. I strongly am against this constant 1 rand per unit NAV, or daily share price. It's just wrong. Assets, as much as they change by tiny fractions on a daily basis, they do. And to have a unit trust.
That's the competitive point, isn't it?
But to have a unit trust with a fixed price is just wrong. It's tantamount to incorrect. We've been discussing this ASISA for the last couple of years. There's a big global debate going on about it, and I think this will spur the debate further. That's the only part of the regulatory regime I'm not happy with.
So Andrew makes a good point. So in Germany and France, no more constant NAV. The rest of Europe's debating it, and it's a good debate. In America, they've differentiated between institutional and retail, and I think that's actually quite bizarre, because the people that actually need to understand is the retail investor, not the institution. Having said that, CNAV, where did it come from? Way back, and Andrew and I have probably been around long enough to remember this. Money market funds were launched to do two things initially: to give the retail investor purchasing power so that they could get wholesale rates. Point one. It
Which
became
they do very well.
Yeah, we became a parking bay for retail investors also, if they wanted to go into the houses, other unit trusts, so they could rand cost average. Sure. And you secure the investor. Then of late, what's happened is corporates that don't want to run their own treasuries are coming into money market funds, and quite clearly they prefer constant NAV because they're getting a better yield and there's no fluctuation in the NAV, which means in terms of IFRS, they don't have to write it up or down against their income statement.
So the money market is now being monopolized, and the rules are being changed to suit corporates, which is not the original intention of the money market.
Look, I don't think that's what Leon's saying. I think what you've got to see it from a systemic point of view. If the banks control all the lending, then the banks set all the rates and the terms. By having a pool of money in the money market funds first, institutional investors like us can negotiate with the banks on your behalf. But further, corporates can come directly to us and we can make loans to them. They can bypass the banks. So disintermediation is a powerful force. This is very good for the economy, of course, brings down the cost of funding. So they play a systemic role, and generally they work very well. The constant NAV, if it wasn't a constant NAV, it'd fluctuate between 0.999 and 1.001 on a daily basis. It would not be a big deal, and yet it would be more honest. When you get an African bank event, it would go to 98.5 cents. Just like that. And you wouldn't have people saying, panicking, running out, and acting like they never had any risk. So there's risks in the funds.
I need to wrap up, but can this get worse? Can African Bank repeat itself? Is African Bank out of the system? Could African Bank be written down further?
Exceedingly unlikely, given the Reserve Bank's comments, given the assets that we know are on the balance sheet. But you must look closely at the Reserve Bank statement over the weekend. The Reserve Bank said, we have to create a framework for banks to fail.
Yes.
To fail without creating systemic consequences.
Now that's big, and that's a big change.
So African Bank's done, but there's a whole lot of banks, and banks in South Africa do go bust, and they do get into trouble.
Yes.
So there will be losses in the future.
Is this the beginning of a new era? Because there's always been the assumption post-Sambo that the Reserve Bank would step in with no questions asked. It has stepped in, and it has taken action with African Bank. This is a change in tone.
But everybody lost some money in the process.
Yes.
They forced everybody, shareholders, pref holders, sub-debt holders, and senior debt holders, to lose money except depositors.
Is that healthy?
And you say, is the beginning? This is stage two. This all started in 2008. Governments don't want to bail out banks anymore. This is how they're not going to bail out banks anymore.
Leon, we have to leave it there. I'm terribly sorry. Leon Campher, the Chief Executive of the Association of Savings and Investments South Africa. Also, Andrew Canter, he is the Chief Investment Officer at Futuregrowth. Fascinating discussion into the state of the money market industry. No doubt there is going to be lots more water under this particular bridge, lots more discussion to be had, and potentially new regulation, which is going to delight the industry no end and make it clearer for you and me. Well, we certainly hope so. That's tonight. I'm Bruce Whitfield. Thank you for watching. There'll be more tonight, tomorrow. Till then, bye-bye.